Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your November 2021 market update. Well, inflation has trended sharply higher since the beginning of this year, with the headline number for the Consumer Price Index reaching 6.2% in October, and the core inflation number, which excludes the more volatile food and energy categories, reaching 4.6% year over year. This is much higher than what we've experienced over the past decade, which I will note was abnormally low relative to history. But nevertheless, the increased price pressures have led to concerns over whether the elevated price pressures will persist. A combination of factors are responsible for the elevated figures. Notably, there was a sharp decline in prices at the onset of the pandemic in 2020. As you can see on this chart, energy prices dropped in March and April of 2020 as countries around the world went into lockdown, which resulted in a severe shock to the energy market. Oil was trading at prices not seen for more than 20 years, and abnormally low prices such as this boost annual inflation in a subsequent year simply because of the math behind this. Inflation is calculated by taking the weighted average cost of a basket of goods and services today and dividing it by the same basket from a year ago. So if you have an abnormally low denominator, your result will be higher. As you can see here, the 50-year average inflation rate for energy is 4.6%, but in October, the year-over-year inflation for energy was 30%. Energy has been a notable contributor to inflation, due in part to that base effect I was just talking about. Demand for gasoline has risen steadily as business activities increase, but supply hasn't been able to keep pace. So to combat some of these pressures, President Biden, in coordination with 5 other major economies, released oil from the Strategic Petroleum Reserve in order to lower oil prices. And while this could reduce the price of gasoline, it will take several weeks to see any effect. The inflationary figures have been further amplified by supply chain disruptions. The production, supply, and transportations of goods was upended due to logistical disruptions created by plant closures and ongoing uncertainties, which made it difficult to accurately schedule production. Once the pandemic started to recede earlier this year, there was significant pent-up demand for hospitality and travel-related sectors. For example, car and truck rental companies sold significant shares of their fleets during the first half of 2020, which left them under-equipped to meet demand as travel resumed. And compounding this issue was that automobile manufacturers couldn't keep up with demand because they were lacking key components such as semiconductors to manufacture new cars. And when you have an immense amount of pent-up demand combined with supply constraints, this naturally leads to notable price spikes, as you can see here. Now, the good news is that we are starting to see some of these pressures abate. The inflationary pressures in car and truck rentals appears to have topped, and it's starting to come back down again, which is a good thing. We're seeing similar moves in the prices of chips, which is shown on the top right there. Within this industry, supply hasn't started to improve, and waiting periods have been coming down. And then in more good news, in the bottom left there, shipping costs appear to have hit a plateau. Just to put some of this increase in inflation from transportation into context, in June of 2020, the cost to ship a 40-foot container from China to the US was about $2,000. Today, that container is likely to cost anywhere from $15,000 to $20,000. So while the cost of ocean freight is still several times more expensive than pre-pandemic, as you can see on the chart in the bottom left here, we are seeing some improvement in inflationary pressures on the margin because the cost of shipping has appeared to plateau, at least for now. So overall, we are starting to see improvement in the areas that are causing some of these higher inflationary pressures. However, the big caveat to this is that all of these charts I've shown you are from prior to the discovery of the Omicron COVID variant. And if this COVID variant evades vaccines, it's likely that we will see even more disruptions in the production, supply, and transportation of goods, which would lead to more inflationary pressures. Now, at this time, we don't know enough about the new variant to make a good prediction in this area. Leading researchers are saying it'll take 2 to 4 weeks to really figure out how it may affect the global economy, but it is something we are watching closely. So overall, this was an area where we were starting to see things plateau. And if this new variant turns out to not be a huge disruption to the global economy, we should start to see some of those inflationary pressures abate. The other question I'm receiving often is, well, what about wage growth? Is that going to cause inflation to spiral out of control? As we learned in the 1970s, the mere expectation of inflation can create a dynamic in which workers demand higher wages to compensate them for the expected loss in purchasing power. And this creates a higher cost for employers, which then gets pushed to consumers in the form of higher prices. So looking at current conditions, the US unemployment rate, shown by the gray line here, has come down quite a bit from last year, but it does remain elevated. Firms are reporting widespread difficulties in hiring qualified employees. And in this environment, firms are increasingly boosting wages to attract qualified employees, which is shown by the blue line here. However, if you compare this to the 1970s, the current labor market structure does have some distinct differences. And so I don't think this is going to be the same effect of a wage spiral like we saw in the 1970s. The first is that while average hourly earnings paid to all employees has accelerated, they have not accelerated enough to keep up with inflation, as shown here. So wages are going up, but you're still not keeping up with inflation. And so you're not seeing that wage pressure in real terms. Real means adjusted for inflation. And second, labor productivity continues to be strong. Labor productivity was decelerating heading into the 1970s, which forced companies to pass on higher costs to consumers more quickly. We aren't seeing that dynamic in the labor markets at this time, which is good. And also, we live in a much more technologically advanced society, and technology is a naturally leads to keeping inflation under control over time. So that we also have that going for us this time around versus the 1970s. So in summary, there are several factors at work in the current inflationary environment, such as base effects and supply chain disruptions. There's certainly a lot more I could have spoken about that could lead to inflation in this overview, but I was trying to keep it short for you. That gives you just a general overview. When looking at inflationary periods in the US over the last 100 years, the current inflation situation is most similar to the 1946-1948 post-World War II recovery period, when we had both a supply shortage due to the fact that resources had been reallocated to the war effort, and there was a surge in demand when the war ended. In that environment, inflation ran high for about 2 years and then abated as supply and demand imbalances eventually normalized. And I think we're in a similar situation to that now, as long as COVID does not remain a disruptive force. If COVID does turn out to be a disruptive force with this new variant, inflation is likely to continue to run a little high. Now, we have already positioned the portfolios accordingly in alignment with these expectations, and we will continue to make changes as warranted. As always, we thank you for your continued confidence, and please reach out to us with any questions you may have.